Good morning, people. Traders. This is my early morning brief here. Early on this morning, we see absolute carnage in the Chinese markets. A little while ago, the Hang Seng Tech Index was down 8% here in the pre-market early morning hours here this morning. Really bad. That is well outside of an expected standard deviation. So this is setting up to be a difficult day ahead in the markets. So heads up on that. You never want to see any major part of the global equities doing outside moves. Can trigger some fear in the global equities. So heads up on that. We are breaking trend support early on this morning here on our S&Ps. Heads up on that. Bottom line is. Um, we have the potential coming down here to 4,073. That's our market maker move low for the week. Very, very high odds probability we might be seeing that today. So heads up on that. So right now we're down 0.5%. If we were to do that, that'd put us down about 2%, 2.5%, something like that, to come down here on ESs in today's session. Slash NQ, that's our index. It's also broken. It broke yesterday. It's broken below our trend. So I do want to zoom in here on the 15-minute here and show you what we're doing here. So basically, right below us, 12,900. That is our 2020 open. So January 2020, that is our opening print. 12,900. I thought we were going to get it yesterday. It looks like we might be doing that here on the open this morning. So we're going to be wiping out a year and 3 months of inventory here on the NASDAQ probably today. So the lows, in my opinion, are not in yet here on our tech. It looks like they definitely want to be taking that out at the very least. So keep that in mind here. Our market maker move low is actually right at this price point too. So remember that. That is the expected move low for the week. So we still don't even have any outside moves on the expected moves for the week. But be aware of that. So coming down to that would actually uh, be the statistical edge of where they expected. And this is all happening before we get in our PPI today. So we're going to have PPI data today, and that's our purchasers price index. So this is our most leading, most important gauge for inflation. And what they typically do and what they're doing right now, they're driving down commodities ahead of the numbers so as not to cause full-on panic in the markets. So keep that in mind. Commodities are coming in really hard this morning because China's selling off real hard. You know, it's amazing how they time this stuff. And it's exactly, this is a lot. They did a similar thing last time the PPIs came out. So your China was down the night before, commodities came in, even though we had a really hot PPI. It's all an attempt to save the markets. Okay. So we're doing the same thing again. Repeat, rinse and repeat. So and the Russell guys. Russell is also right here near our market maker move low uh, for the week. Okay, so we're probably here pre-market here going to be tagging our expected move low here on that, and we do have the Fed coming out later this week as well. So remember that as well. But NASDAQ or the Russell's not looking very pretty either. Okay. So just keep that in mind going forward here. Okay. So I had the wrong setup, so I had to change it real quick here. This was our weekly pivot. We're below all of our major pivots here on all the indices, with the exception of maybe the Dow Jones. So, and remember the PPI. We're also getting manufacturing data coming out today at 8:30 as well. So they've been holding up the Dow Jones in lieu of that information. So definitely keep that one in the back of your head. I can definitely see us coming down here to the December 2020 lows, 18,800. Or your 1880 would be here on the Russell. Definitely possibility here. So basically, the alpha areas of the markets, and that's your NASDAQ and the Russell, they're acting relatively weak relative to the rest of the markets. So just keep that in mind going forward in today's trading. So The real problem going forward here, we'll start with LQD. And you do not want to ignore what's happening here. I'm going to go out on a weekly time frame. Okay, so bottom line is the Fed came in, announced an asset purchasing program in the height of the COVID crisis. And what they did, they came in and they started buying up corporate debt and putting on supposedly grade A corporate debt, putting it on the government's balance sheet. Okay, so basically, they have recently came out and said they're going to unwind that program, and we're technically supposed to have already ended it, but this meeting right here is supposed to be the announcement that they've stopped doing the corporate buybacks. What we got going on here, because we have another outbreak going between Russia and between what's going on in China, we have the corporate debt market imploding once again. Okay, we are having a mirror reaction just like we had back during the COVID outbreak. So bottom line is the Fed going to come in here and say, well, we're going to extend the corporate buyback program and continue to buy up corporate debt to save the markets? This is the backbone of the entire market system. And so bottom line is basically the Fed came in, drove down yields, and these corporations have all been doing share buybacks at really cheap. They've been able to do these share buybacks at very cheap yields. So basically, what we got going on here is an unwind of that situation where yields are spiking through the roof, and the buybacks are no longer feasible. So we're going to be losing that whole aspect of support in the markets with this complete and total unwind. So basically, the Fed came in right here and they put the market on crack. They said, we've already got plenty of liquidity in the markets, but we're going to buy up all the debt too. So that's pretty much what's been going on here ever since COVID, the main COVID outbreak. So you really have no idea just how important this week is to the overall global markets. Bottom line is we've already given halfway back using my Fibonacci retracements. We're sitting right here waiting for the Fed to come out and say whether or not they're going to continue in a very highly inflationary environment, if they're going to continue to do change their mind and continue to buy up corporate debt. Okay. Bottom line is they do not have a mandate to buy up corporate debt. That's a new thing that they've come up with. But this threatens to completely unwind the entire markets. And historically, what you do whenever markets are in correction, you buy up bonds. Well, the bond markets are just ridiculously overpriced already. So now we have a situation where the bond markets are imploding and the stock markets are overpriced. So you have all these retirees that, they're supposed to be rotating their money into the safest areas in the market, the bond markets, which now is a quite dangerous scenario going into this correction. So basically, the only safe place you can put your money and actually technically possibly lose money is put it in cash. That's really one of the few areas that you can actually put it. So just keep that in mind here. And ultimately, I think at the end of the year, what you're going to see is major rotation out of U.S. equities into Europe and to China. Okay. And that because historically, you would just rotate into the bonds and the money would stay in the United States. We have a situation here completely different to where it's not safe to put it in U.S. bond or anything into U.S. equity bonds because of the big spike in yield, potential big spike in yields that we're starting to see here. So heads up on that going forward here. So LQD, this is your grade A corporate bonds. Then you have your JNK, it's imploding as well, and HYG. So that's what's really going on. This week is so, so, so important on which direction this market's going to go. And the Fed is in an impossible situation. They've created themselves a bubble, and we're right there with the needle right next to the balloon. And I just don't know what they can do here. The only thing they can do is promote hotter inflation, and ultimately, that's going to be devastating for manufacturing if they promote the extremely hot inflation. But ultimately, they really don't have any other choice but to maintain hot inflation for longer than what they normally would want to. So just keep that in mind going forward here. Please like my video. Please retweet it on Twitter if you get a chance. And so that's just pretty much all I got to say here. There's really not. There's so much data coming out right now that you don't want to really overthink things. I'm looking for a really tight inside day ahead of the numbers, but keep in mind the PPI, I think it's going to be even worse than last time. So that comes out at 8:30 this morning, and so I'm looking over 8% on PPI numbers coming in this morning. So heads up on that. Um, and like I said, they're trying to give the illusion that the inflation is short term going into those numbers. They love doing this. So and well, what can I say? You know, if the markets buy into it, they buy into it. So there you go. That's some things I wanted to flow here. Oh, also to finish it out here, early on this morning, Baba's getting destroyed again. I think at least $72 on Baba this week. JD's getting hit really hard early this morning. Like I said, commodities coming off, so the energy, the long energy play is coming off pretty hard this morning. Okay, and then like I said, tech was getting destroyed in China this morning. Remember, two of the major cities in China. I don't know. I haven't heard lately. As of yesterday, there are two major cities. One of them being a major manufacturing hub for Apple. They're shut down for a week. Okay, utterly shut down. That's why Apple was so weak yesterday. Okay, and UVXY is up again, and the VXX. Remember, guys, VXX Barclays came out yesterday and said that because of the risk of, well, basically it comes down to, you saw what happened to nickel. Well, Barclays, they trade these derivatives. They feel like that they could be in the same situation with VXX as what happened with nickel. You could have an uncontrolled gamma squeeze in this, so they are going to get out of the VXX. They're no longer going to. I'm not really for sure exactly what the clarity is, but they are closing out their positions in the VXX. So we may not even see VXX anymore as a trading vehicle. So be aware of that. Uh, so be aware. Right now, we might be setting up for a big gamma squeeze given that announcement. So be very aware of what's going on here in the VXX. Uh, you know, typically they continue to, what I understood the information, they continue to, as demand comes in, they issue more shares. I understood from the press release that they're not going to issue any more shares. But and if that's the case, then that could actually cause even a faster gamma squeeze in this one here. So be aware of that. Hopefully, we'll get more press release on that. Very dangerous. Do not assume that this is going to trade like you think it will until you read through it and really understand what's going on with this instrument. Technically, I personally believe this is a hands-off instrument going forward here. I'm no longer going to even follow this one. So be aware of that going forward here.